Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, I'm Steve Brice and I'm Standard Chartered's Chief Investment Officer. Today I'm speaking with Manpreet Gill, our Regional CIO for Africa, the Middle East and Europe, about our macro strategy for the second half of the year. When we released our 2023 outlook, we argued this year would be much better than 2022. Now, that's not difficult, of course, but given the dramatic sell-off we saw in both equities and bonds last year. However, even we were not looking for the strong rebound we've seen so far, with the diversified growth allocation up around 7% year to date. We've just released our second half outlook, Keep Calm and Carry On. Manpreet is here with me today to discuss the key conclusions of this report. So Manpreet, thank you so much for joining us. So obviously we're all in this boat together, right? We still face some significant uncertainties, including the timing and potential magnitude of a US recession and the outlook for US and China geopolitical relations. So what do you mean when you say keep calm and carry on?
Hi, Steve. So I think at a very high level, it goes back to two of our key investment principles. So stay invested and invest with discipline. Now, we think that's important because looking at the where we are in the year today, we just believe two extreme narratives are jostling for investor attention. First, there's a no landing scenario, which argues for chasing equities higher as the US avoids a recession altogether. But there is a second scenario, which argues that risky assets are not worth holding at all as a deep US recession awaits. So it's easy to get knocked off track by either, the promise of quick wins or the heightened fear of an uncertain outlook. But as you've already said in the introduction, I think few of us would have predicted the strength of returns in the first half of the year. But actually, by staying invested in a diversified portfolio, you dramatically start to increase your chances of winning and of building wealth over time.
Okay, let's start exploring CALM. So what do the C, A, L, and M of CALM stand for?
Well, to start with C, C is for capitalize on market opportunities. Now, against the backdrop we just described, we actually prefer high-quality bonds against most major asset classes, but particularly relative to cash. Now, in our view, cash rates are close to peaking, and that's why we believe investors are better off locking in longer-term rates now rather than rolling the cash at lower yields in the quarters or indeed the years ahead. Because in any economic cycle, Fed fund rates usually go lower as economic growth starts to slow. That, of course, pushes yields lower, which can be a challenge if you're trying to roll over cash yields, but it can actually be to the benefit of bond prices. So not only do we expect quality bonds to be a source of income, but they also offer the potential for capital gains in economic downturn, which is why we advocate quality bonds, particularly related to cash. On the other hand, outside, we've also upgraded equities up to a core allocation. So in our view, a combination of an overweight view on developed market investment-grade government bonds and a core allocation to global equities allows us to really balance the strong equity momentum we're seeing today against what we still believe to be a delayed but still real risk of a US recession.
Okay, so that's the C of CALM. What about the A and the L?
Well, A is for allocate broadly. I think in an environment of strongly competing narratives, we expect diversification to trump a concentrated approach. Now, we've always been of the view that investors should hold a well-diversified foundation allocation. That's not only about the overweight bonds and core allocation to equities that we just described, but also complementing that with core allocations to gold, liquid alternatives, or private assets, depending on what you have access to, because these assets can act as good portfolio diversifiers. Now, on gold, we believe robust central bank demand is likely to put a floor under gold prices, and gold, of course, generally benefits during risk-off events. But when it comes to alternative strategies, liquid or private, there is quite a bit of evidence that shows they lead to better portfolios. And indeed, these strategies demonstrate the value in 2022 by facing much more muted volatility than other major asset classes. So that's on A, but L is for lean towards Asia. Now, we expect Asian equities to outperform global equities. And that's not just an Asia ex-Japan call, but actually an Asia including Japan call. And when you sort of start looking at some of the key markets within that, there's China, where China's economic opening was indeed visible in the economic data, but as we now know, it failed to translate to equity market gains as US-China tensions kept investors away. But we believe domestic policy is likely to turn increasingly stimulative as policymakers become more concerned about deflationary headwinds. So that should help unlock value in Chinese equities. We also have Indian equities, where we're quite positive on the structural outlook. And the market has held up surprisingly well despite the central bank tightening we've seen in India. And as valuations continue to ease off their highs, we believe that starts to create better value for long-term investors. And finally, there's the Japanese equities, where we've upgraded them to overweight. The outlook, in our view, is attractive because we've got nominal GDP growth starting to accelerate, given inflation has picked up. But share buybacks and dividends, we think, are also supportive factors. So that's on the Asia, including Japan equities. But even on the bond side, we do like Asia US dollar bonds. And that's, of course, for their credit quality, for the yield on offer relative to what you can earn in developed markets. And, of course, the fact that it denominates in US dollars. So that should mean they benefit from falling US bond yields as well.
That brings us finally to the M of calm. What does that stand for?
Well, the M is for manage volatility. And I think the point here is that, we believe investors should be prepared for episodes of heightened volatility, not only on the downside, but on the upside as well. Now, in the C, A, and L, we spoke, of course, for the key components of foundation portfolios, but M is really talking about opportunistic allocations, which can also be an additional source of returns, particularly in today's context. And we have sort of three ways, I think, of looking at that in the second half of this year. First, of course, is equity sector strategies, where we look to more barbell style strategies in the US and to some degree in the euro area, where we sort of try to balance between both defensive and cyclical sectors to balance the upside and downside risks. In China, though, still a focus on more consumer-oriented sectors, which we believe will see more support from policy and earnings. The second, of course, is FX. We have a view that at least over the next 1 to 3 months, the dollar is likely to remain range-bound before weakening, on a 12-month horizon. And that, of course, is likely to create lots of range trading opportunities in the short term as we go through the second half of the year. And finally, of course, we look for opportunities to sell volatility. Today's equity volatility levels are quite low at the lower end of recent ranges, and we believe they have room to move higher. But of course, if we get these spikes, they tend to be short-lived, so we'd look to sell into those in order to generate an income.
Okay, thank you so much for your insights, Manpreet. That's a brief overview of our outlook for the second half of 2023. To find out more, please look out for our H2 Outlook report, which you can download from the link in the podcast description. In the meantime, thanks so much for listening today, and Manpreet and I wish you a fantastic second half of the year.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.